You work hard, you earn decent money, and yet your retirement account still looks embarrassingly small. Maybe it's a few $1,000s, maybe it's basically zero. And every time you hear people talk about compound interest and start early, you feel the same fear rising. How am I ever going to get to the point where my money works for me, instead of me working forever? For most ordinary workers, the first real milestone isn't $1 million. It's the first $100,000. That first 100K is the wall almost nobody climbs. And if you never get over that wall, you never really experience compounding. You're just scraping by, saving a bit, losing a bit, and watching the clock move toward retirement with a growing knot in your stomach. The scary part? There are specific traps built into the way our system works and into the way our emotions react to money that quietly keep you from ever reaching that first 100K. If you don't see them clearly, you can work for 20 or 30 years, earn a solid income, and still arrive in your 60s with almost nothing. In this video, we're going to look at 3 retirement traps that keep ordinary workers from ever hitting that first 100K. And we're going to look at them through the eyes of Benjamin Graham, the father of value investing, the man who built his entire philosophy around protecting ordinary investors from speculation and permanent loss. By the end, you won't just understand the traps. You'll have a simple, rational, Graham-style plan to escape them and finally get your first 100K working for your future. And just to be clear, this video is for educational purposes only and is not personal financial advice. You're responsible for your own decisions, but what you'll hear is grounded in conservative long-term principle, not hype. Let's start with the uncomfortable truth. You can be a responsible adult with a decent job and still be on track to retire broke. You show up to work every day. You pay rent or a mortgage. You help your family. You pay taxes. You're not lazy. You're not stupid. But when you open your retirement account, you see a number that doesn't match the years you've already put in. Maybe you're in your late 20s or 30s with almost no savings. Maybe you're in your 40s or even early 50s and you're terrified that's too late. The system encourages you to spend now and worry later. Banks, credit card, car finance companies, and even social media all push you toward lifestyle upgrades, not long-term security. At the same time, when you do try to invest, you're bombarded with noise, hot stocks, crypto, complicated products, aggressive strategies that sound smart but feel like gambling. Benjamin Graham drew a sharp line between investing and speculation. An investor, in his view, is someone who makes decisions based on careful analysis, seeks a reasonable return, and, most importantly, prioritizes safety of principle. A speculator is someone focused on price, movements, predictions, excitement, and short-term action. Graham's entire philosophy is about giving the ordinary person a way to act like an investor, not a speculator, even if they're not a professional. He talked about margin of safety, leaving room for error in your analysis, your assumption, and your expectation. He described the stock market as a manic Mr. Market who shows up every day offering you a price for your shares, sometimes very high, sometimes very low, based on his moods, not reality. Most ordinary workers never reach their first 100K because they approach retirement as speculators. Even if they don't realize it, they're reacting to moods, noise, and fear instead of following a simple, protective plan. So let's diagnose what's really happening before we talk about a solution. Think about the typical pattern. You tell yourself, I'll start saving properly later when I earn more. You vaguely intend to invest when the market looks safer. When the market goes up, You feel like you missed your chance. When it goes down, you feel like it's too dangerous. So you stay in a strange middle zone. A bit of cash here, a workplace plan you never look at. Maybe a small dabble into whatever your friends are talking about. The result? Years pass. Your income goes up, but your retirement number barely moves. Your lifestyle expands to fill your paycheck. Nicer car, better apartment, more subscriptions, more dinners out. You feel like you're doing okay, but your future self is being quietly starved. Imagine someone named Mark. He's 38, earns $70,000 a year, and has been working full-time for 15 years. He has a retirement account with about $12,000 in it. He tells himself, I should have more, but life is expensive. Once I'm making 90 or 100K, I'll finally start taking this seriously. Then a recession hits. He panics, stops his small contribution, waits for the right time to restart, and never really does. At 48, he wakes up with maybe 40, 50K, a mortgage, kids closer to college, and not enough time left for slow compounding to bail him out. Mark wasn't lazy. He fell into traps that were invisible precisely because they're normal. Now imagine someone else. Call her Lisa. She feels behind too. One day, fed up with feeling stuck, she decides, I need to catch up fast. She throws money into whatever is being hyped as the next big thing. Speculative tech stocks, options, or trendy assets she barely understands. When the market turns against her, she loses 40 to 50% of what little she invested, feels burned, pulls out, and decides investing is just a casino. She goes back to doing nothing. Both of these people are trapped. One is paralyzed and delayed. The other is reckless and burned. Both are blocked from that first 100K. Graham would look at this and say, the problem is not the market. The problem is behavior and the lack of a rational plan. He would remind you that the stock market and even the whole retirement system is like Mr. Market, moody, emotional, and often irrational. If you let Mr. Market dictate your feelings and actions, you'll always be late, scared, or overexcited. Instead, Graham wants you to base your decisions on intrinsic value and margin of safety. Intrinsic value is the real underlying worth of a business or a basket of businesses based on earnings, assets, and long-term prospects, not the daily price. Margin of safety is the cushion between what you pay and what something is reasonably worth, plus a cushion between what you hope for and what you actually need. In retirement terms, margin of safety means things like this. You save more than feels comfortable. You assume lower returns than the sales brochures promise. You keep your costs and fees low. You avoid situations where a single mistake can ruin you. Graham also distinguished between two types of investor: the defensive investor and the enterprising investor. The defensive investor is the busy worker with limited time and energy. This investor doesn't try to beat the market or pick individual stocks. They focus on diversification, quality, and discipline. The enterprising investor is willing to put in serious analytical work and accept more effort in exchange for potentially better return. Most ordinary workers, especially those struggling to get to their first 100K, should think like defensive investors. That means simple, boring, repeatable actions that protect you first and let compounding do the work. You don't need brilliance to reach your first 100K. You just need to avoid the traps. So let's walk through the 3 big retirement traps that keep ordinary workers from that milestone and how a Graham-style approach helps you avoid them. The first trap is the someday trap, delaying your first 100K because you think you'll save later when you earn more. This is the most common trap of all. You tell yourself a story. Right now is unusual. Expenses are high. Things will calm down later. Once I get the raise, once the debts are sorted, once the kids are older, then I'll really start. Time passes. Your income rises, but your lifestyle quietly expands to match or exceed every raise. Instead of paying yourself first, you pay everyone else first. Landlords, lenders, retailers, restaurants, and hope that something will be left over for your future. Most months, there isn't. Emotionally, this feels harmless. You're not doing anything obviously reckless. You're not day trading or buying strange assets, but mathematically, this is devastating. The first dollars you invest early on are the most valuable dollars you'll ever own because they have the longest time to compound. When you delay, you're not just postponing savings, you're erasing years of potential growth that you can never get back. Graham's lens would say, you're leaving yourself no margin of safety and time. You're assuming everything will go smoothly later, that you'll always have higher income, good health, no job interruption, that there will be plenty of years for compounding once you get serious. An intelligent investor doesn't make that assumption. So, what's the Graham-style alternative? You treat saving for retirement as a mandatory expense, not an optional leftover. You pay yourself first. Before lifestyle, before upgrades, before nice-to-haves. A portion of your income, even if it's small at first, is automatically routed to long-term investment. You can start with 5%, 10% or more if you can. The exact number matters less than the decision that retirement money comes off the top, not out of the leftovers. You also accept that your first 5K, 10K, 20K will feel painfully slow. That's normal. The growth is barely visible in the beginning. Your job is simply to keep adding fuel. You're building the base that will become your first 100K. The second trap is almost the opposite, but just as dangerous. It's the catch-up fast trap, trying to reach 100K quickly by speculating instead of investing. This usually begins with the realization, I'm behind. Maybe you're 35 or 45 and your accounts are far below where you feel they should be. You feel pressure. And that pressure makes you vulnerable to stories of quick gains. Suddenly, conservative, boring path feels inadequate. You don't want 6 to 8% over decade. You want big jumps now. So you chase hot stocks, short-term trades, leveraged products, complex strategies you don't fully understand, or whatever is dominating financial headlines. At first, you might even get lucky. A trade or two works out. Your confidence grows. But from Graham's perspective, you've crossed the line into speculation. You're no longer basing decisions on clearly understood value and risk. You're reacting to price moves and stories. And when Mr. Market swings the other way, as he always does, you discover the cruel part of the catch-up fast trap. Losses hurt you more than gains help you. If you lose 50% of your small nest egg trying to double it, you now need a 100% gain just to get back to where you started. You've taken a temporary opportunity, the chance to steadily compound from a low base, and turned it into a permanent setback. Worse, the emotional scar often drives people out of investing altogether. I knew this was all a scam. The market is a casino. I'll just stick with cash. Graham's alternative is clear. He would say, if you're a busy, non-professional investor, your default stance should be the defensive investor's stand. Focus on broad diversification through simple, low-cost funds or high-quality, well-diversified vehicles. Focus on regular contributions, not heroic bets. Your goal is not to impress anyone with your picks. Your goal is to make sure your capital survives and grows reasonably over time. Instead of asking, how can I double my money fast? You ask, How can I avoid a catastrophic mistake that destroys years of savings? That mindset protects you. The third trap is the confusion and fragmentation trap. Letting complexity, scattered accounts, and constant strategy changes keep you stuck below 100K. This one is more subtle, but it's everywhere. You start a retirement account at one job, then leave. You don't roll it over. You start another somewhere else. You open a brokerage account after watching a video. You buy a couple of random funds. You have a savings account earning almost nothing. You carry some credit card debt just for now. You hear about target date funds, robo-advisors, dividend strategies, growth strategies, value strategies. Every year, you feel pulled in a new direction. You might even be doing some things right, but there's no coherent plan. This confusion has two big costs. First, fees and inefficiencies quietly eat away at your progress. High expense ratios, trading costs, advisory fees, hidden product charges, they all reduce the rate at which your money grows, especially when your base is still small. Second, the mental clutter discourages you from taking consistent action because you don't fully understand what you own or why. You're more likely to stop contributions when the market falls, hop between strategy, or sit in cash until things feel clearer. From Graham's perspective, this is like owning a random collection of businesses without any clear idea of their fundamental strength, earnings power, or relationship to your goals. An intelligent investor, especially a defensive one, wants a simple, understandable policy they can stick with through thick and thin. So what's the alternative to this fragmented confusion? You step back and design a simple Graham-style investment policy for yourself. Not a complicated spreadsheet with dozens of slices, just clear answers to questions like, what percentage of my money will be in stocks versus bonds or cash, given my time horizon and my tolerance for risk? Will I use one or two broad, low-cost stock funds and one simple bond fund? What is my automatic monthly contribution amount? Under what circumstances, if any, will I change this plan? You then consolidate where it makes sense, rolling old accounts into one main retirement account or a small number of clear buckets, reducing overlapping funds, and favoring low-cost, diversified options. You treat fees like leaks in a ship. The bigger the leak, the more likely you never reach your destination. Now let's pull these ideas together into a practical plan you can actually use. How do you move from where you are today to that first 100K in a Graham-style way? Start with a brutally honest snapshot. Look at your current age, your current savings, your income, and your expenses. Don't beat yourself up. Just get the facts. Ask yourself, if I changed nothing, where would I likely be in 10, 20, or 30 years? Does that picture allow me to stop working at a reasonable age with dignity? Then, define your first milestone, that first 100K, and not in a fantasy way, but with a realistic timeline. Maybe, with your income, a 7 to 10 year path is achievable if you commit. Maybe, if you're older and starting late, you still treat it as your first serious goal, even if your eventual target has to be higher. Once you have that milestone, build your plan around 3 pillars that map directly to avoiding the traps. Pillar 1, automatic, non-negotiable contribution. Set up an automatic transfer to your retirement or investment account every time you get paid. Treat it as a bill you owe your future self. Even if it starts small, lock in the habit. Then, whenever your income rises, increase that percentage before your lifestyle expands. When I get a raise, some of it automatically goes to my future. That's how you defeat the someday trap. Pillar 2, a simple defensive investment approach. Choose a small number of diversified low-cost funds often broad market index funds or equivalent vehicles, and make them the core of your portfolio. Decide on a reasonable stock-bond mix for your situations. For example, if you're younger with decades ahead, you might be heavily in stocks with a smaller bond cushion for stability. If you're closer to retirement, you might shift more into bonds and cash. The exact mix is less important than the discipline. You're not chasing hot sectors or doubling down on speculative bets. You're accepting that boring, consistent compounding is your ally. This is how you avoid the catch-up fast trap. Pillar 3, a written, simple rule book for dealing with Mr. Market. Before the next market storm hits, decide in writing how you'll behave. For example, if the market falls 20 or 30%, I will not sell my broad funds. I will continue my automatic contribution. If anything, I'll consider increasing them if my situation allows. I will not make investing decisions based on headlines, friends' tips, or short-term prediction. I will review my plan once or twice a year, not every time there's a scary article. I will measure progress in terms of my contributions and my long-term goals, not by what happened this month. These rules protect you from yourself. When the market crashes, and it will many times in your lifetime, people without rules turn temporary declines into permanent losses. They sell low, freeze contributions, and lock in damage. With a Graham-style rulebook, you behave like an intelligent investor instead. You see a crash as Mr. Market offering you shares at a discount, not as the end of the world. You're not thrilled about the volatility. You understand that your future doesn't depend on this month's price. Step by step, month by month, you cross quieter milestones. First 5K, first 10K, first 25Ks. At some point, if you stay consistent, something interesting begins to happen. Your returns, even at modest rates, start adding more to your account each year than you did in the early years. Your money begins to work with you, not just for you. That's the psychological power of the first 100K. It's not magic, but symbolically, it marks the moment where compounding becomes visible. And all along the way, you're acting more and more like the person Graham wanted to protect and empower. The intelligent, ordinary investor who refuses to hand their future over to speculation or fear. So, what does this mean for your identity? Most people around you will continue to act like speculators, even if they never use that word. They'll chase the latest trend, panic in downturns, delay saving, then try to sprint later with risky bets. They'll talk about the market like a casino. They'll complain about governments, inflation, and the system, while never actually building a margin of safety for themselves. You can choose a different identity. You can see yourself as an intelligent investor in training, not perfect, not immune to emotion, but committed to behaving differently. You're someone who pays themselves first, consistent. You accept that getting rich slowly is safer than trying to get rich quickly and failing. You deal with Mr. Market's mood swings using a plan, not panic. You value protecting your future family from financial stress more than impressing strangers today. This path isn't flashy. It won't impress people at parties. It won't make headlines. But it's the path that gets ordinary workers from zero to their first 100K, and from there to a retirement that's truly theirs. When you feel doubt, remind yourself of the stakes. This isn't just about numbers on a screen. It's about whether your 60 or 70-year-old self has choices. Can you stop working on your terms? Can you help your children or grandchildren without wrecking your own security? Can you face the future without constant financial anxiety? Every automatic contribution, every decision to avoid speculation, every boring month where you stick to your plan to vote in favor of that future. If you found this helpful and you want more content that applies Benjamin Graham's calm, rational philosophy to real problems ordinary investors face, consider subscribing to this channel. Like the video if it clarified these traps for you, and let me know in the comments which trap you see most clearly in your own life or in the lives of people around you. From here, a great next step is to watch a video that walks through how to build a crash-resistant Graham-style portfolio. Something simple, diversified, and disciplined that can survive market storms without you needing to predict anything. Remember, you don't have to be brilliant to reach your first 100K. You have to avoid the common traps, protect yourself like an intelligent investor, and give compounding the time and fuel it needs. That's how ordinary workers like you quietly build extraordinary security.